Hello, everyone. Thank you so much for joining us today for this webinar hosted by the USAID-funded Water Sanitation and Hygiene Project, or WASH-FIN. Over the next hour, we're going to present some findings and observations from a recently completed landscape assessment that gives an overview of financing facilities that are designed to aggregate, leverage, and blend sources and uses of finance for WASH and other sectors. So I am Steve Senna. I'm the USAID WASH-FIN Deputy Chief of Party, and I will be moderating today's webinar on behalf of our presenters. First, we're going to have Ella Lazarte, who's a Senior Water and Sanitation Advisor in USAID's Water Office. Sam Houston is going to present. He's the Chief of Party for the USAID WASH-FIN project. And Alma Poshunkula is the Country Team Leader for the USAID WASH-FIN Philippines activity. You can see their bios in the email invitation for more information. Before we get started, just a few things to know about the webinar platform. There'll be Q&A at the end. There's a panel located on the right side of your screen. You can submit questions at any time during the presentations, but they will not be answered until we hear from all of our speakers. If you're having any technical issues, Grace and Dan on our webinar technical team from the USAID CKM project will do their best to help you out, and they'll monitor the Q&A box for any issues. Today's webinar is being recorded, and we will be sharing the recording with you next week. You can find the slides and the landscape working paper from today's presentation under the Handouts tab. The slides are in a PDF format with webinar in the subject, in the file name. The recording and related resources will all be available on USAID's Water Sector Knowledge Hub, globalwaters.org. So I'm pleased to now turn things over to Ella Lazarte from the USAID Water Office to make some brief introductory remarks.
Thanks so much, Steve. And good morning, everybody, or good afternoon or evening, depending on where you are in the world. I'm really excited about this webinar and very grateful for all your interest and participation. And also thanks to the speakers this morning, all of whom are part of the WASH-FIN project team that Steve just mentioned earlier, and I will be talking a little bit more about that shortly. I'm not the star of the show, as you know. It is about talking about the landscaping study and also the Philippines Water Revolving Fund, so I'll just keep it brief. As we know, and if you could see on the slide, there's most people probably in this webinar are aware of the globally recognized need for extra sources of finance for WASH service delivery. Presently, there's a big gap between the financing required and that which is available, which is about estimated to be $114 billion annually, about 3 times the historic levels of investment. Public resources available to achieve the ambitious universal WASH access goals are limited, as most of you know, and that includes host government and development finance institutions funding. In general, host governments spend between 1% to about a little over 3% of their national budgets on WASH. In Kenya, where WASH-FIN has supported tracking public investments, we found that between the years of 2014 and 16, expenditures on WASH was less than 2% of the total budget. And here in Nigeria, where I currently am, the government spends less than one half of 1%, but the need is clearly much greater. Some estimate that to be about 2%, it could be more. Just for comparison's sake, an OECD report from 2010 mentions that 3.5% of countries' GDPs are needed or was needed back then to achieve the Millennium Development Goals. So that's nearly not enough to meet what we need to achieve by 2030 and beyond. And the limited financing that's traditionally been provided by the public sector has been generally through what we call the 3 T's, tariffs, taxes, and transfers, with the latter raises concessional debt from international finance institutions, or IFIs. So to bridge the financing gap, we really need to determine ways to fully leverage the financing available from the private sector through instruments such as commercial loans, capital markets, equity investments, and the list goes on, including public-private partnerships for certain segments in which the private sector can take on some of the risk of investing in water and sanitation with the expectation of a profit. And obviously, there's a lot more that belongs to this list. So what's our response as the USAID? And I'd categorize it as basically a two-pronged approach, one at the strategy level and another one at the programming or programmatic level. So at the strategy level, we've elevated through the U.S. government-wide Global Water Strategy launch in 2017 and the upcoming USAID Water and Development Plan, we've elevated the importance of strengthening water sector governance and financing, and that's very much clear in public documents that you'll see and also just internal documents in terms of what we prioritize. And at the programming level, whether it's bilateral, regional, or global, we're also developing programs or have developed activities that tackle this big issue. And today we'll just talk about the global program that we have called Water Sanitation Hygiene Finance, or WASHFIN. I won't say that again, it'll be WASHFIN from now on. And that is, I'll just give you a little bit of a flavor of what WASHFIN is about before I let the stars of the show speak. So WASHFIN's focus areas, the next slide please. So if you look at the WASHFIN's focus areas, we have four, and the overall objective is to provide technical assistance and services to help municipalities and service providers track and mobilize greater financial resources for improved service delivery. Sounds easy. Well, it's not. So we do it in these four pillars that you'll see. I won't read through the slides, you have them. The first one is sustainable business models. It's really important that we establish a solid financial foundation for increased public investment and access to private sector financing from local banks by focusing on developing the commercial viability of service providers. And without this, it'd be really hard to mobilize financing in the sector. The second one is domestic resource mobilization. It's really more about the advocating for and tracking increased public investments. Both public and private sectors have to do this together. And third one is access to repayable finance. With the figures that I just mentioned a couple minutes ago in terms of public spending, it's all the more critical that water and sanitation providers access repayable finance through the diverse mechanisms that I mentioned. And that's the focus of the webinar today, which is in more specific terms on financing facilities that fall under this pillar of the WASHFIN work. And the fourth one, as you see, is really, you can see that in action through this webinar. WASHFIN fully integrates the knowledge sharing and learning efforts that we have into the project and country activities, as well as at the global level through webinars and channels like this. Next slide, please. I promise this is the last one, and just to give you a little bit of information on where WASHFIN works, I don't need to name all the countries there. It's a 5-year program, and the aim is to work in at least 8 countries in Africa and Asia. So we're still working on expanding to at least one more country at the moment. And it's really relevant in terms, the topic of today is really relevant given that the portfolio of WASHFIN is working with financing or towards establishment of financing facilities in countries as diverse as Mozambique, Nepal, Philippines, Senegal, and South Africa. And why is that important? I just wanted to make a comment a little bit on why is that important to USAID and what's the big deal about it. Well, USAID has had a long history of supporting the development of financing facilities, as some of you guys in the audience might know or be familiar with. For instance, there's the FIRD in India in the 1990s. A recent evaluation was conducted by USAID about it, and it's in the global water site, so I won't say too much more about it. But the evaluation did find that nearly 10 years since it ended, many of the reforms have been carried forward and built on by government and other partners in today's Root Urban Reform Program. And another example on the other side of the world is South Africa through the Municipal Infrastructure Investment Unit, which was one of the facilities profiled in this study. And it lasted until 2006, when it effectively transitioned into the government as part of the PPP unit, National Treasury. And lastly, last but not the least, the Philippine Water Revolving Fund, developed through a tripartite agreement of the government of the Philippines, the US, and Japan. And without saying a little bit more than Philippine Water Revolving Fund, since that will be discuss in the next few minutes. I'll stop there. I will just say that the landscaping study was meant to be an internal product for us to inform our global wash bin portfolio and USAID work as well. But we decided to share it more broadly through this webinar and other channels, hopefully to spark some good discussions and inform your work as well. So looking forward to your questions and feedback. And I'll turn it over to the real show, to Sam. Thanks.
Thanks, Ella, for that useful introduction. So now turning to the focus of today's webinar, the financing facility landscape assessment that the WashFin project conducted. So moving on to the next slide, I'll just give you a brief overview of what's included in today's presentation. We'll start out by talking about what is a financing facility. We'll move on to discuss some potential advantages for establishing such facilities. Then we'll do an overview of the landscape study itself, followed by some selective lessons and observations coming out of our work. And then finally, we'll end with a discussion from some experience from the Philippines around setting up the Philippines Water Revolving Fund and some follow-on work that WashFin is now supporting in the Philippines. Next slide, please. So to begin with, what is a financing facility? For the purpose of this study, we came up with a fairly broad definition so that we could have a working definition to take us through the study. So a financing facility is an institution that mobilizes investment for water and sanitation infrastructure investment with the primary objective of mobilizing often local currency and capital from domestic and or private sources. Additionally, it's possible that financing facilities have other aspects to their structure. This may include supporting preparation of bankable projects and providing technical assistance, and facilities also might be structured to provide credit enhancements if and where needed, and they may include credit guarantees or things such as debt service reserve funds, things of that nature. Next slide, please. All right, so why is there a need for financing facilities? As Ella mentioned in her introductory comments, it's quite clear that the demand for WASH services far exceeds what service providers and governments themselves have the capacity to finance on their own with internally generated revenues. And so the financing gap is massive. Additionally, it's clear that the needs for finance are complex, and they're often further complicated by internal governance challenges, and collectively these challenges often appear too risky for most investors. Additionally, most service providers, especially smaller ones, are often have low creditworthiness and have limited capacity internally to prepare bankable projects that are ready for investors. And finally, large numbers of relatively small providers have increased transaction costs from comparatively small transactions that all require the same level of due diligence to prepare and to vet for financing. And then finally, facilities can institutionalize capacity to streamline investments into the sector overall. So moving on to the next slide, we just wanted to give a visual to help participants kind of think through what are some common examples of potential illustrative structures for facilities. The first structure is a non-repayable one, where you can see that the financial flows through their system are one direction. The middle repayable concessionary one, you can see how there is an expectation of repayment, at least from the water service providers and potentially from the finance facility to its overall source of capital. At below market rates due to the nature of the concessional and public funding being accessed. And then the final generic model is a blended model with the expectation of repayment, but also taking advantage of the opportunity to blend in private finance and private capital to expand the capital pool for investment into the sector, and with the expectation that the higher the blend of private finance, the closer the terms of lending become, the closer the terms are to market repayment rates. So that's just to help think through common structures of what funds might look like. So moving on to some of the potential advantages of establishing financing facilities. They're numerous. They include facilities can aggregate projects to create larger and less risky investment pools, and they can distribute transaction costs for across the pool that's maintained by the finance facility. They can also blend and leverage grant and concessionary money with commercial financing to increase the overall investment pool. Depending on how they're structured, they may include mechanisms to support project preparation and to provide technical assistance to tee up bankable projects and projects that are ready for investment. Facility can be structured so that it can segment, rationalize, and incentivize the sector investments and actors. So this might mean making sure that grant money is targeted at the poorest communities or the least credit-worthy utilities, while more credit-worthy and better performing utilities are encouraged to take on higher blends of commercial money at near market rates, so that the sector can maximize the opportunities for investment going into the sector overall. Next, facilities can institutionalize and standardize reliable and less costly local currency investment. Instead of service providers having to kind of shop their finance proposals around to a variety of commercial banks directly, you know, a facility might be able to streamline those processes where there's one or two windows for a facility that could entertain your financial application all at one spot. Without requiring too many duplicitous efforts with sourcing finance. And finally, facilities can improve self-reliance and governance through domestic resources and local institutions. So all of this sounds quite compelling, and you know, behind this there's a lot of nuance and complexity, because if all of these good things happened all at once, you would expect facilities to be established all over the world. And so one of the things that we set out to do under this landscape assessment, which I'll talk about on the next slide, was to try to capture some of this nuance and complexity to better understand the landscape overall. So the landscape was to provide a broad overview of existing and nascent financing facilities, and to include related project preparation and risk mitigation facilities where they existed. Originally, this effort started out to be focused on preparing an internal reference document for our own benefit, implementation benefit, but we're now, as Ella mentioned, turning it into a working paper so that we can share some of the lessons and experience more widely within the community of sector professionals. An additional goal was to collate experiences from the various facilities to understand different structures and components and advantages and disadvantages of how other facilities were structured. And finally, we wanted to emphasize facilities that did leverage private capital for development, but also had a role for public and sector investment as well. So moving on to the next slide. Just to talk a little bit, quite briefly, about our approach. So this started out as a desk review effort where we had a long list of facilities considered. We drew the line at 100 facilities that we looked at. And we did do brief profiles for each of those facilities. And then we started to focus in on a group of 20 where we did a little bit deeper dive. And when possible, we would conduct interviews to flesh out any information that we thought would be quite relevant to inform our study. So how did we scale down our identification of the facilities that we considered in the study? We looked at geographic. We wanted examples of global facilities, regional and national, but also from multiple regions of the world. We looked at the types of facilities in terms of how they were structured. We considered facilities that were beyond the wash space. So, municipal infrastructure funds, climate funds. We wanted to make sure we learned lessons from across the development space and not only in the sector. We did look for funds that involved donors, and how donor funds may or may not have been blended into facility designs. We did prioritize funds that had a preference for mobilizing and blending in private capital to expand investment pools. And we looked at funds that had clear success factors and also challenges, the model of fund structuring itself, and also where information was available. So on the right side of this slide, you'll see how the working paper was structured, which you can have a look at in detail when you download the working paper. But moving on to the next slide, you can see how we might have rationalized the structure of the working paper around the distinction between three types of facilities and their focus. And quite often facilities included more than one of these types, but it's useful just to talk through these three types of facilities and how they may or may not be included in a facility structure. So working across the project cycle, often it's been identified in the sector that establishing the background documentation, building up bankable projects has been a key obstacle for investing in the sector. So project preparation facilities really focus on that aspect of the project cycle. So it's looking at things like, or working on things like detailed engineering designs, refining a utility or municipality's business plan, looking at debt capacity, and ultimately putting together financing proposals that are ready to move to the next step. The next category is financing facilities themselves, which is really geared towards moving money towards shovel-ready bankable projects in the sector. So that's kind of the core objective of the sector, is to move money in a sustainable and reliable way to meet the financing goals and needs for infrastructure. And so this is the core of what most facilities do, while the project prep and also risk mitigation are kind of add-on features that may help the overall functionality of a facility. So risk mitigation, as I mentioned before, could include things like credit guarantees and debt service reserve funds, and it's looking at opportunities to reduce risk to increase overall throughput of finance into the sector. So moving on to the next slide, looking at the finance facilities in particular, we broke this category down into 4 categories, depending on how they structured themselves. And the details of these structures and examples are included in the working paper, and I certainly encourage you to have a look at those. But just to run through these examples, types of examples with some illustrative examples from real life. The first one includes public facilities using concessionary debt and grants, and there's a few regional facilities that we looked at in the study, namely the European Union Water Facility and also the European Union Africa Infrastructure Trust Fund. The next subcategory is around debt finance facilities operating on repayable terms, and a few that we looked at in the study include the U.S. state revolving funds administered by the EPA and the Philippines water revolving fund, which we'll hear about a little bit more later in the presentation. Some examples of bond banks considered include both the Mexico bond banks examples, but also some examples from the U.S. The third category around commercial equity funds. These are strategic investment funds, and the example that comes to mind from the working paper includes the Pan-African Infrastructure development fund. And finally, combination funds, which are facilities that integrate functions across the program cycle, including debt or equity financing facility, can include grants for project prep. Some examples that we considered were Africa 50 and Climate Investor 1 structures. So those are some illustrative examples that are included in the working paper, and I do encourage you to look at those in more detail. So moving on to the next slide. This is the final slide on some select lessons and observations that we drew from considering the functionality and the structuring of the funds that we considered. So breaking this down a little bit into 3 sections, the first one being around governance and facility management. It's quite clear that any facility that's being put together to move large amounts of infrastructure capital into a sector requires really significant oversight, strong management, and governance, because ensuring that funds are well utilized and properly managed is absolutely pinnacle for encouraging investment into the sector overall. So management and governance cannot be understated. Moving on from there, it's very much tied to operational leadership and staff capacity. The project cycle for water and sanitation requires a wide range of professional skills, from finance people to engineers and economists. And so, ensuring that a financing facility has the right staff and the proper staff capacity to make sure that the facility can operate in an efficient manner to move funds into the sector responsibly is also kind of an obvious thing that needs to underpin any structure that is set up. And finally, a common challenge that we saw was balancing different objectives. So financing facilities might have certain development objectives that are given to them from the policy level when they're established and initially structured, but those development objectives often have to be balanced off against financial objectives around return on investment or maintaining certain levels of liquidity so that the fund can continue to operate on a financially sustainable basis. So that's a common issue that came up on the facilities that we considered. Moving on to the second category around overall market context and the operating environment. I think it shouldn't be taken for granted that there's a willingness to borrow from service providers. It very much depends on the market. Some service providers, haven't reached universal access, but don't really feel much political pressure to expand coverage, often into poor areas that are uncovered for a variety of reasons. And so it shouldn't be assumed that there is a willingness to borrow, despite the fact that there's clearly a gap and a need for increasing service provision by utilities. Additionally, common across the sector, political will is often a challenge. Setting up these financing facilities often takes quite a long time, and ideally these types of facilities should be set up with a consensus across the political spectrum, so that a facility isn't associated with a certain party or political position and doesn't change with the election cycle for countries. Additionally, the level of market development is quite important, particularly if there's an expectation of blending in private capital. The more advanced capital markets are and the more competitive and liquid the local banking market is, the more realistic it is that you're going to find opportunities to blend in private capital as the local banking and local investors look for more and more opportunities within their markets. And finally, the regulatory framework is often a stumbling block, and it's having a clear regulatory framework for establishing a financing facility mechanism is often a prerequisite to move on. So the overall enabling environment is something that needs to be considered quite closely at the beginning of a process considering the establishment of a system. So moving on to the final category on my last slide here, financing facility structures and techniques. As I mentioned before, lack of bankable projects is a common problem in the sector. Despite the obvious need and for investment, the projects often aren't ready or aren't of investment quality from a financing perspective. And so technical assistance is often the oil that lubricates the engine to establish bankable projects and to move potential projects through the project cycle towards completion. And so including opportunities for technical assistance in financing facilities has proven quite often to be a critical aspect of making sure that there is plenty of throughput through any potential facility that's designed. Next, project cycles that increase across the, consider the entire project cycle are the most likely to succeed because they have the opportunity to influence and control aspects from beginning to the end of the project cycle, and that allows maximum flexibility. Everyone likes the idea of revolving funds. Who doesn't want to see repaid money from the sector be reinvested into the sector? However, one thing to note here is due to the long-term nature of investment into water and sanitation infrastructure, repayment periods are often quite long. So it does take quite a long time for capital to begin to revolve in facilities, and that's something that needs to be considered quite carefully when thinking about the liquidity of a fund, when it's being structured at the beginning. Pooled finance facilities show a lot of promise for aggregating smaller projects and distributing risk of those projects across an entire portfolio, and can be attractive to investors that have minimum ticket sizes. If you're only looking for investments of 10 million and over, and you've got a lot of secondary towns that need $500,000 investments, it's possible that a pooled facility can aggregate those investment possibilities into something that might be more attractive to investors depending on the investor profiles that are being considered. And finally, it's been shown, there's been several cases where credit risk assessments and risk management can really help ease investor concerns around investing in facilities, and it's something that should very much be considered in the overall market context when designing facilities in order to look for opportunities to maximize the investor potential into a certain fund. So those are the select lessons that came out of our working paper, and at this point, we'd really like to pivot and share some more tangible examples from a particular experience where USAID had some experience supporting setting up some financing facilities in the Philippines, and we'll be hearing from our colleague Alma, who's the team leader from WashFin Philippines. So Steve, I'll hand it over to you for now.
Okay, thanks very much, Sam, and thanks everyone for listening in. Yeah, I'm pleased to pivot now over to Alma Porciuncula, who's the WashFin Philippines activity team lead. And Alma was the chief of party for the USAID project that supported the implementation of the Philippines Water Revolving Fund. So I thought it would be great, Alma, if you could give us maybe just some brief overview in terms of the background and the context of how PWRF got going, and then tell us about the experience, and then maybe we can have I have some questions that I'm hoping you can answer.
Okay.
Thanks.
Thank you, Steve. I'm really excited to share our experience with you. And as Steve said, let me start by giving you a brief context on the PWRF development. PWRF was conceptualized when the Philippine government committed to achieve MDG targets, and that translated to providing water supply and sanitation services to 10 and 15 million people respectively. The required investment at the time was estimated at 3 billion but public resources available were at 1 billion only. So cognizant of this huge funding gap, government adopted a financing policy to steer credit-worthy utilities towards market-based sources, especially private banks. However, at around this time, private banks and investors perceived public water utilities to be highly politicized and therefore risky. So this was one constraint that had to be addressed if private resources were to be mobilized. Fortunately, then, the Philippine financial market was very liquid and banks were looking for new opportunities. So they were open to new ideas. With the assistance of USAID and JICA, the Philippine government looked at international examples on leveraging private resources, particularly the US State Revolving Fund and the pooled bond financing in India. But the enabling conditions for either model were not present in the Philippines. We did not have public funds to capitalize a reserve fund. Earnings from bonds were taxed, therefore not that attractive. And because of the market liquidity, banks were aggressively marketing direct loans, so in a way competing with bonds. Hence, the Philippine government had to look at other opportunities, and the immediately available resource at that time was concessional ODA funding that could be used to co-finance private bank loans. When we conceptualized the PWRF, we had two critical considerations. We had to take two critical considerations in mind. One, that it should have little impact on the fiscal space. And two, the loans should have long tenor. The tenor should match the economic lives of the public utility assets. Affordable rates and relaxed hard collateral requirements. Hence, the PWRF structure, as you will see in the diagram, was such so that the ODA loan to the government bank did not require full budget appropriation, rather a provisioning for the sovereign guarantee or the contingent liability only, so less impact on fiscal space. The long ODA grace period, 10 years in the case of the JICA loan and tenor, 30 years, enabled the liquidity cover for private bank loans. At the time, these loans had a 7 to 10-year tenor only, but the private banks agreed to amortize loans over a 15 to 20-year period as they were assured of bullet payments should they opt out on the 7th or 10th year. The guarantees from LGU Guarantee Corporation, which is a domestic private corporation, and the DCA co-guarantee enabled the relaxing of hard collateral requirements to mere assignment of revenues. So, Steve, that was a brief background on the PWRF development.
Okay, well, thanks, Alma, for giving us that background. So, just thought I'd follow up on that and try to tease out some of the things that that you experienced in overseeing the Philippines Water Revolving Fund project on behalf of USAID. So, as Sam mentioned, in the landscape, we observed that project preparation, the technical assistance required, and credit assessment play a critical role, but it's often underappreciated when these facilities are designed and stood up. And it's, we're finding it through our experience to be a pervasive and persistent obstacle in accessing non-traditional sources of finance for the sector. I'd like you to tell us a little bit about your experience with Philippines Water Revolving Fund in this regard, in terms of how the fund handled project preparation and the technical assistance that was required to mobilize investment.
Mhm. We did realize early on that it was not enough to put up the fund and investments will materialize. We had to address the challenges and enablers of the fund. So our efforts included training of utilities on strategic business planning, on preparation of business cases and full-scale feasibility studies, and commercial loan application. We also trained banks on water supply and sanitation project appraisal and familiarize them with the regulations, institutional setup, so they can assess risks and identify mitigants better. We also help establish a credit assessment system for utilities under the LGU Guarantee Corporation, and we conducted marketing forums with private banks and utilities. These efforts contributed to demand generation among utilities and fostered confidence among banks to lend to the public utilities. Uh, we've seen later on that private banks gained confidence, as I mentioned, and they progressed to sole loan origination after the co-financing arrangement and offer more competitive interest rates and terms. For example, private banks offered variable interest rates with one-time option to fix the rate. This allowed the utilities to enjoy the prevailing low interest rate regime and at the same time having a safeguard to fix their rate once the market rates go on an upswing. Steve?
Okay, thanks, Alma, for that response. So in terms of the overall effectiveness of the PWRF and how it was perceived in terms of success over its long trajectory and up to today, where I understand it's no longer operational. And so I kind of have a two-part question. First off, is this considered a failure, or was this just a logical or a well thought out step along the road to self-reliance for the sector in the Philippines? And then the second part is, if you could speak to a bit on how PWRF may have helped the stage for the current government efforts regarding what's called the Unified Financing Framework. And I know you're working on that on WashFin's behalf, and just how that policy reform agenda for the sector is going forward in terms of master plan.
Mhm. Okay. Let me start off by saying that PWRF mobilized about $200 million of investments, and this translates about 7% of the MDG investment requirement. These projects can benefit around 6 million people. So from nothing to this much contribution, I think it's a success in that sense. But more than the financial resources mobilized, I do believe that the biggest contribution of PWRF to the sector are as follows. One, it opened the market for private lending to the sector. Private banks are now originating loans on their own, which I believe is a better, progression from the ODA co-financing arrangement. It's more sustainable and it doesn't at all, impact on the fiscal space of government. Secondly, the development and implementation of the PWRF brought to fore the need for a three-pronged reform program to compel investments, and that is independent and effectively enforce economic regulations, institutional strengthening and utility governance improvement, and then the financing incentives. These reforms have been integrated in the recently completed sector master plan, or the Philippine Water Supply and Sanitation Master Plan. Third, it informed the long-term financing reform, as you mentioned, which we now call the Unified Financing Framework. Or can you go to the next slide, please, Steve? So as you will see from the slide, the policy framework rationalizes the use of public resources for targeted subsidies. And we're giving priority to areas with highest incidence of poverty and waterborne diseases and lowest access. And further leveraging of private sector funds. Government plans to provide viability gap funding for economically viable but financially unviable projects so that even these projects could access commercial funding. Direct grants will be given to poorest households using an output-based aid mechanism to subsidize water supply connection or build sanitation facilities. Finally, next slide, please, Steve. The master plan discusses government's deliberate game plan on the what and where to utilize the different financing sources. As you will see in the slide, government plans to source at least half of the financing from private sources. So this time around, I think government has very clear game plan on how to finance the sector. And it aims to mobilize greater private sector resources through commercial loans and even private capital or equity investment through the PPP projects. So that in a nutshell is our experience and lessons from the PWRF development.
Okay, thanks so much, Alma. It's striking to me the fact that under PWRF, it looks like you were able to mobilize about 7% of the total investment through that mechanism to achieve the Millennium Development Goals. And now we're facing the SDGs, which are coming up shortly, and we see that now the sector or the government in Philippines is looking at what amounts to about 50%. So that's quite an ambitious target. And it seems like the commercial loan aspect of roughly 40% is PWRF has hopefully set the stage for moving towards that goal. So
It did indeed. Yes.
yeah, okay, well that's great. So just to recap quickly, Ella gave us, I think, a good overview of the need in the sector as we do approach the SDGs, and she mentioned some other examples. Sam went through the landscape and also talked about what we found and what the lessons and observations were that we took away from that. Critical things like strong management and governance, on the environment or the enabling environment in the market context, the political will, regulatory framework, and then on the facility structure and different techniques to move money into these facilities and out into the sector, was to address things like how to get more bankable projects through technical assistance, use of different structures appropriate to the context, and credit assessments and risk management, possibly through credit enhancements. And I think Alma kind of closing the circle on a lot of these things with how the PWRF was implemented, how they looked at other models, how they adapted or came up with the appropriate model that they saw at the time, and how they addressed the challenges that they clearly identified. So it's really a great lesson. The Philippines Water Revolving Fund Closeout Report from USAID is one of the handouts. There's also a handout on the Fire D ex post evaluation that USAID did recently, and a chapter from a guidebook that was produced under Fire D specifically on infrastructure investment. And there's also, of course, the landscape assessment report, which is WashFin's working paper, which is out now and on Global Waters as well. So with that, I would like to turn it over to some audience questions, and we do have some that have come in. So one of the questions that maybe Sam could take is, we've heard, the question is basically saying, we've heard now that these financing facilities can be quite impactful and a way to move money in, but if they have so much potential, why is the uptake of these facilities so slow?
Yeah, thanks for that, Steve. I think that the potential advantages are quite clear, but as you say, why are they not everywhere? And I think there's a variety of reasons for that. It does take sustained long-term political will and commitment by the government and development partners to ensure that the correct enabling environment and regulatory framework is in place to set up a financing facility like this. And it does require a long-term vision in terms of, here's the funds that are available for investment versus the massive gap, which is maybe an order of magnitude larger. And how can we reform our structures in order so that we can be a bit more creative about bringing in additional money into the sector? And that might mean upending the status quo, which could be unpopular, and there's institutional inertia around the status quo often, and that can be difficult to overturn. And so often these types of things require a champion or a group of champions that have a vision to ensure that the right conditions are in place so that private capital in particular can be unlocked and leveraged to really begin to chip away at the massive financing gap that most countries have.
Okay, thanks, Sam, for that response. Another question that came in is quite specific, and I'm thinking, Alma, maybe you could take this one. It's around risk appetite of the banks, and in terms of the water and sanitation sector. In your experience, what were banks looking at in terms of risk? What were their risk assessments based on or dependent on?
Well, there were a variety of risks that they had to look into. There were technical risks, there were political risks, and there were economic risks. On the technical risk, this would mostly be the quantity and the quality of water. And therefore, it's very important for the feasibility studies to identify a sustainable source of water and assess its quality as well, so the project would be able to treat the water properly. Secondly, there was an issue on regulations. Um, what we have very disaggregated regulatory framework here in the Philippines, uh, and several utilities are actually not regulated. In particular, these are the LGU or local government run utilities. Um, The other utilities which have a corporate structure, these have an independent economic regulator. So the banks tended to veer towards this type of utilities, or the what we call the water districts. Most of the PWRF loans were on the creditworthy water districts. Um, Third would be political. Um, Political influence, particularly on how tariffs are set. This is somehow related to regulations too. The LGUs, because they're not regulated by an independent entity, they're more prone to political interference. Water districts are much less politically influenced because of the presence of the independent regulator. So the PWRF, we recognize, has a certain clientele, and these are the creditworthy corporate type of water utilities. And therefore, when the government prepared the unified financing framework, it had to have a segment that focuses on the less creditworthy water utilities, and that's where we target the subsidies and the grants, and the more creditworthy ones would be veered towards market-based sources.
Okay, thanks so much, Alma. So, let's see, I have another question. I think, Sam, if you could take this one. The question is around let's take a country that's struggling to meet even basic wash needs for its population. Can a country like that really manage a financing facility like you're talking about here?
Yeah, thanks for that, Steve. I think that there's quite a bit of flexibility around how financing facilities are structured and how they begin. And so, um, I think anything is possible, especially when there's good collaboration between development partners and host governments. WashFin is working in Nepal, that has had the Town Development Fund for almost 30 years. Actually 30 years this year, and they've worked with a series of development partners, including I think originally GIZ and later the Asian Development Bank, to capitalize a structure that makes investments into secondary towns with partial requirement repayments. I believe it's a 70% grant, 30% repayable structure that really rolls out water infrastructures to high need communities, often that haven't had any access and are fairly far down the income ladder. So I think anything is possible, and it just depends on the partners sitting around the table to figure out what's most appropriate for each context. And so that could be everything from least developed countries to more sophisticated middle income countries with established capital markets, where the government is much more committed towards increasing the capital pool and bringing in private capital to expand the amount of investment much further beyond what the public sector could do on its own. And so there's always options, and it's just making sure that lessons from how facilities are structured are appropriately targeted for a particular context.
Okay, thanks, Sam. The next question I think I'd like to give to Ella, because it's coming from someone who's an implementer of USAID WASH programming, and they're wondering what financing facilities mean in terms of helping a country on the journey to self-reliance. Are you there, Ella?
Yes, I'm here. Thanks,
Okay,
Steve.
sure.
Yeah, thanks for that question. I won't have too much time to talk about the journey for the self-reliance. Just for those in the audience who don't know, I mean, that's really, for us, the purpose of our development assistance is really for us so that it must end, so that there won't be any need for us to exist anymore in the long term. And our vision is really to help partner countries along the path towards self-reliance, which we define as the ability of a country to plan, finance, and implement solutions to its own development challenges. And so I think we see a potential for this. I don't want to be quoted. I know we're recorded. What does it mean for us? Does this mean, for example, that are we going to establish finance facilities in half our countries or a certain number of countries? And that's not certainly what we have in mind. When we talked about having this landscape study with the WashFin team, the impetus really was a thorough examination of the supply side and the experiences to date. I love the optimism, Sam, and I think I would say we're cautiously optimistic. I mean, given all the lessons that you learned through this review, I'm sure there's a lot more nuance that we could go on and on discussing. It's not easy to have these facilities, have them function, and have them be sustainable. And I think Sam talked about the importance of TA as the oil that lubricates the engine. Alma talks about kind of having the right conditions. Financial markets were open in the Philippines and open to new ideas. And so I think it's something that we say, yes, let's definitely explore it. And that's why we have this landscaping study and the WashFin team also behind us to really help us think through where is it that it's feasible. It doesn't mean that a USAID country program or bilateral program will establish its own. It could be building on something that was already started. So that's how we look at it. It's also informing our discussions with other development partners. Sam mentioned really the importance of, anything is possible when there's good collaboration between host country governments and development partners. And I want to end with that, because I think without that, I am not sure how successful these financing facilities could be. And it's informing our discussions with organizations such as the FDB in the Africa region. And so, yeah, I'll stop there. Thank you.
Okay, great. Yeah, thanks, Ella. And that is another observation, and you probably heard every time a facility was discussed, it was peppered with a variety of government entities and also development partners that were supporting this. So collaboration and coordination is clearly a key aspect. So we've actually passed our 1 hour mark, but if anybody wants to stay on the line, we do have more questions, and I think we can spend another 5 minutes or so to continue the discussion, because we do have some questions that I think are quite relevant and would be of interest to the audience. So one of the questions is around the PWRF. So that would be for Alma, and the person is asking if it was structured to revolve beyond the life of the loans. So was the fund replenished through these repayments or contributions from user fees or fiscal allocations? What was the revolving setup of the fund?
As you probably remember or recall, I said that the JICA loan had a tenor of 30 years with a grace period of 10 years. The PWRF loans had 1 to 2 year grace period only, so the repayments came in earlier than the expected time to repay the JICA loan. And this early repayment was used to revolve the JICA loan. But we started in 2008, and in a way finished the co-financing scheme sometime in 2013, because that was a time when the banks were originating loans on their own. So the figure that I actually gave you earlier, the $200 million, that covered the co-finance projects as well as the solely originated loans of private banks.
Okay, thank you. Thank you for that. So another question related to PWRF is how, so regarding the CapEx and capital expense and the operational expense of the PWRF facility, how was that structured? Did, for example, the person's asking, did the government of the Philippines do the CapEx and did the private operator take care of the operational expenditure? Maybe if you could speak to that side of the structure, that would be helpful.
Okay. So under the co-financing arrangement, there's capital investments that's being provided from the JICA loan and then from the internal funds of the private banks. Operating expenses were covered, separately by the Development Bank of the Philippines, which is the one relending the JICA loan, and then the private banks themselves. So there was no additional resource that came from the national government. Each of the parties lending covered its own operating expenses.
Okay, thank you. So another question for you, Alma. You're getting a lot of questions. So this one comes from a colleague in Kenya who's saying there, and we know this from Washington experience, that there's a lot of political influence that we're struggling with there, often from regional leaders in the counties. So how can you give us some insights into the experience with the PWRF, into what helped mitigate against political influence that would maybe deter commercial orientation that you needed in order to get bankable projects?
Well, admittedly, we weren't that successful with the LGU-run utilities because these were indeed, the most politically influenced. We were successful with the water districts, which are corporate entities and which had an independent regulator. Having an independent regulator and a clear framework in terms of how tariffs are set uh, lessened the political intervention. So the banks were quite comfortable with lending to these water districts.
Okay, thanks. Another question that came in is related to the role of concessional sources of finance, so concessionary loans. Maybe Sam could take this one. In general, in these facilities, is this seen as an enabler, or is this seen as a hindrance to uptake?
Yeah, thanks, Steve. I think the answer to that question depends on how concessionary money is brought into the sector. Obviously, money that is below market rates and is more affordable is potentially highly advantageous for the sector. However, it's important that that money is deployed in a way that doesn't minimize investment opportunities. So, for example, if concessional money is being used to target partially credit-worthy utilities to bring them up the credit ladder and move them in a direction that improves their performance and overall operations for the prospect of potentially accessing market finance in the future, that's great. If concessionary money is being targeted at the best performing utilities in a country that are already credit-worthy, you're undercutting the establishment of a market for lending into the sector. So I think it very much depends on how concessionary money is deployed, and if it's done in a rational way that is targeted, it can be very advantageous. If it's done in a way that doesn't consider the overall development context of the sector, it can be quite well, it can undercut opportunities to expand investment into the sector. So it's very context driven, I guess, is the takeaway message.
Okay, thanks so much, Sam. So while we do have a few more questions coming in, unfortunately we've run out of time, but I would like to thank all the presenters, Ella, Sam, and Alma for a great job and giving us insights not only into the broader landscape, but into the specific examples discussed and the Philippines Water Revolving Fund experience. Thank you all to all attendees for participating in this webinar and for the great questions that were asked. Again, all of the materials will be on the USAID globalwaters.org web platform. The handouts are available on the handout tab, and you will be getting emails to follow up with more information about the various handouts and what have you. So again, thank you everyone for this for taking the time today, and we look forward to working with you to hopefully bring more finance to the water and sanitation sector. All the best.